This
this out
conference
a
will
little
now
bit.
be recorded.
You know, Jacob, what do you think is, we have a couple of more minutes. I think
Hmm?
we are at 15:34 hours right now. We still have people pouring in, so probably give it another 2 to 3 minutes.
Yeah.
Uh, that's a very interesting, viewpoint that you shared. Uh, Given the kind of experience you have, and you clearly worked in multiple markets, uh, what do you think? Uh, is one major misconception professionals still have about IFRS 9 or ECL modeling today?
So I actually, I wouldn't necessarily say it's. I mean, one of the misconceptions. I think it's more mentality. I think part about it thinking about what we used to have from the incurred loss perspective. So it's common to say, okay, previously we had incurred losses, and now we want something that's more forward looking. And while that is not wrong, I think because then people say, oh, this forward lookingness and all of that, it's really, really exotic. We have never seen something like that. And I often say you should shift the perspective 180 degrees. What you should rather say is, my starting point is fair value. Fair value we have had for a very long time. Sure, we did not use to fair value most of our assets, but we still know what the fair value concept is. We are very familiar with the stock market. We're very familiar with sort of how fair value dynamics work. And now we rather say, okay, I don't want everything in fair value. I don't want market rate changes. I don't want credit spread changes. I want to factor out, keep the credit because I'm exposed to that. So I now get a sort of reduced fair value measure. And this is what the ECL is, or at least a proxy of that. And I think that's a really important shift because sometimes you hear people who says things like, okay, you can't really calculate, this is such an exotic object. How can you need to have a crystal ball? And when we do a lot of valuations on our books within accounting, we don't have the crystal ball. We don't know for sure what's going to happen. The whole point rather is that we should say, okay, if I know that everything indicates that things are going to get worse, I should already reflect that in my financial statements now. And I think that's a little bit of the mentality we should have about IFRS 9. We should not view it as a sort of upgrade on the incurred loss. We should rather view it as a simplification of fair value. And I think that sets more management expectations because if you come to management and say, okay, guys, the starting point is that we have to put things at fair value. Okay, that feels really complex. Now there are some certain circumstances, you satisfy the business test, you satisfy the SPPI. Okay, then you get allowed now to reduce the complexity and only have to look at the forward-lookingness of the credit risk, not all the other factors. I think that's also a better way to sort of argue for management, what is it that we're doing? Because it sort of it puts a lot of these effects that okay, people say, okay, why can you, for example, for example, our own bank, we had now last quarter we had negative credit losses, and then the market says, how is that possible? How can you have negative credit losses? And you say, okay, but let's say that you bought a ton of bonds on market, and it was really bad times, and now times becomes better. Those bonds are gonna become more valuable, and you book that in your P&L as a gain. So that's a negative credit loss. And people say, aha, wait, okay, that's much. Then if you think go in more with that mentality, I think that also helps to understand what are we trying to do in this whole project. We're basically trying to figure out the value of an asset, and there are certain restrictions in the standard that means that it doesn't become fully straight test, but it basically means this mentality of thinking sort of fair value instead.
Some really interesting points you brought up, and what I've realized about the audience that we have, and of course we'll start with the session in another 2 minutes.
Hmm?
uh, in the meanwhile, if you could just help me understand that. So from what I understand, you worked in both consulting and internal model building environments, right? So how
I
do
have
those
primarily worked, yeah, I primarily worked for banks, but I worked in, let us say, three sort of different roles. I mean, One, if you think about it from IFRS 9 perspective, I mean, the first and most important role is, building the models. So that's basically where I sort of started out. And then I moved on to model validation, which is basically you try to look into the standard and you try to understand, okay, how is the modeling working? Are we doing the right thing? And then I've also finally then worked on an additional perspective, which is the sort of stress testing. So you're now not using the standard yourself, or you're not doing the ECL yourself, but you rather want to use it for other purposes. And I think this is one of the sort of core reasons that becomes quite interesting, that you see the standard from sort of different point of view. And I think that, for example, one of the things that is really helpful is that if you work in sort of model building, it is often helpful to have some experience in model validation, or try to get that experience over time. And reversely, I would say you become a much better validator if you have model building experience. And I would also finally say, you should also always, if you build models, in particular, if you work in model building IFRS 9, be really interested in the accounting side of it, because this is an accounting regulation. I think that was one of the things I'm most happy about, that when I started out, I think I built my first sort of model. And then after that, my manager basically said, okay, we have some downtime now. Take some time, we will supply you with some resources, learn some of the, because I don't come from the accounting side myself. So learn some of the accounting, talk to some of our people, and really understand the what happens on the accounting side, and what is the regulation we are supposed to target. And I think that have helped me a lot, that, you've seen the modeling, you've seen the machinery, but you also then read and try to compare that to what it says in the standard, and try to understand that. I think that really helps a lot, and have helped me get a full picture. And finally, currently I actually work more on actually the sort of financial risk side. And at first, I would, because I helped out with some interest rate risk matters. And first I thought that was a little bit sad, okay, that takes you quite a far away from IFRS 9. Turns out that actually helped me also quite a lot, because if you think about it, as I mentioned before, this is about valuation. It's a valuation problem if you think about it. And I think what for example, interest rate risk and similar have been very good at is focusing on this valuation aspect. And I think we, as sort of credit risk specialists, can learn a lot from this sort of valuation and market risk perspective. And especially sort of if you talk interest rate in the banking book, where they have stuff that never touched the market, but they still try to say, okay, how is the fair value changing? You can learn a lot from looking with the same perspective on credit risk.
Perfect. So we are now at 15:40 hours. I think with that audience lineup is pretty good. So now, without further ado, I'll just get started. So good evening, everyone, and welcome to Dexlab Analytics IFRS 9 Masterclass. It's an absolute pleasure to have over 50 professionals with us today. The audience today is from global banks like ABN, AMRO, and Emery Price, to independent consultants, fintech professionals, risk leaders across Europe, India, Asia, and beyond. We also have learners and practitioners of the industry. Whether you are an experienced market risk officer, financial analyst, model validator, or someone building a strong foundation in IFRS 9 or ECL modeling, this particular session has been designed to bring clarity, structure, and strategic depth to your credit risk journey. So, in the next 45 minutes, below are the few topics or conversations our guest is going to touch upon, them being building and validating PD models in compliance with IFRS 9, handling low default portfolios and data scarce environment, using forward looking scenarios and embedding macro risk factors, and last but not the least, clarifying the SICR framework not just for compliance but as a true business signal. And it's very important that we understand this bit. Your speaker today with us is Jakob Lavröd. He's a globally respected credit risk and analytics expert. Like he just mentioned, he's worked closely with top financial institutions. He's worked in markets like Europe, the Middle East, and Asia on IFRS 9 implementation, model governance, and risk analytics transformation. And before I hand it over to Jacob, a quick word before we dive in. I would also like to mention that Dexlab Analytics offers an advanced hands-on IFRS 9 and credit risk related training programs designed for professionals who want to go deeper with live projects, validation techniques, and regulatory reporting insights. We will share more about that at the end should any one of you would like to know. Now, without delaying it any further, uh, let's get started. Jacob, over to you, requesting everyone to take notes. Should you have any queries, make a note of them, put it in the chat box, keep your cameras open, keep your microphones on mute, and as the session progresses, if you want to ask something, raise your hand, drop in a comment. We will take questions at the end. We do have 10-15 minutes kept apart for the same. So, Jacob, over to you. I'll be here to help you out.
Sure. So will you share the slides?
I'm bringing that up right away.
Excellent, excellent. Thank you so much for the very nice introduction. A great honor to be here. And as mentioned, I'm a bit of a sort of IFRS 9 fanatic. Really love the standard a lot, and it will be super honor to get to talk about it. And in particular, the sort of aspects that we will be focusing on today is in particular the sort of probability of default. In your classical standard, you have the probability of default, the exposure at default, and the LGD, and you multiply these three things together to get the expected loss. We will primarily be discussing the PD today, as that is yeah. So if we move to the first, if you move to the first slide, so exactly. So we will be. The thing to kick off with here is even before we dive into the quant things of PD, we actually have to understand we say probability of default. So what is this default things concept we are about to measure? So if we go to the next slide. So what is it that the standard is really telling you? I think always, when you work with IFRS 9, I always recommend, go back to the standard and see what is it saying. And this paragraph I'm showing here is the most important one in all of IFRS 9. It's paragraph 5517, and it basically says, what are you supposed to do when you measure your expected credit losses? So it basically states sort of three criteria. And it talks about in A, it talks about an unbiased and probability weighted amount determined by evaluating a range of possible outcomes. And this feels like a lot of text, but what it basically means is that we need to weight the different alternatives that exist. Basically, if you think it very simplicitly, and basically you can have a scenario where you take losses or you don't take losses. Notice also that we don't hear mentioned explicitly sort of, the PD, EAD, LGD. In general, that terminology came from IRB, internal rating-based methodology, that was a sort of Basel developed standard. IFRS 9 was developed by ISAB, the International Accounting Standards Bureau. They don't really have sort of that sort of three parameter focus, but it turns out that using these three parameters become a very powerful tool. So this is also why it's the thing that have dominated the calculations. And also, finally, you see in the bottom that it talks about reasonable and supportable information that is available without undue cost. Without undue cost basically means if you have it internally, you are expected to use it. And also it mentioned this sort of, past events, typically sort of data that you have collected, current conditions. So what are the variables for the loan or the asset currently in, and forecast of future economic conditions. So that you also, this sort of macroeconomic environment that you need to look at. So if we move to the next slide, you could argue sort of from sort of these things that you have seen, why do we really need to have the PD? So if we move to the next slide. So the first thing you can ask is, when we say default, what is it that the standard is telling us? Well, the standard doesn't really tell us to be using, the standard doesn't really prescribe a specific default. What it says, and which I've highlighted here, is that you need to use something that is consistent with the definition used for internal credit risk management. And this is really a red thread going through all of IFRS 9 calculation, that what ISAB tells you is, you as an institution, use what you have typically internally. So you should not say, okay, when it comes to capital management and when it comes to internal credit risk, okay, I use these tools. But for IFRS 9, I have set up this very, very distinct standard. They're very clearly saying, don't do that. Instead, make sure to align them. But what they are saying, and what they say in this sort of third paragraph here, is that you still have something that you need to be aligned with. And that is one of the things is this 90 days backstop. So you're basically to be told that, if a customer is 90 days late, you should expect that there is a serious problem. It's important to mention default doesn't mean that it's a total game over. You could absolutely have customers and loans that come back from default, but default means that there is such a serious risk that you don't just expect it in the short term to be able to be paid. And you might say, oh, but after 90 days, at 91 days, the customer might just send in the money. Sure, but you as an institution are typically expected to have been in contact with the customer. You have talked to the customer. You have ascertained that, okay, there's actually a sort of serious issue. We don't expect you guys to just sort of sit there and wait. And then after, 90 days have passed, you now raise the phone and call the customer and say, what is going on? And this is also where these sort of unlikeliness to pay, the UTP indicators come in. So you are expected to basically, if let's say hypothetically tomorrow, a really good customer now calls you up and say, I've lost my job. My wife also lost her job. Our household has no income. We have no ability to pay. And you say, okay, let's try to work something out. But still, this is now probably something where you should do it to default because the repayment capability has completely disappeared. So, for example, I give this example that it's quite common, especially if you take a sort of European perspective. What you typically tend to do is that you tend to set a counter at 60 days, and after 60 days. So if you have someone that have not paid you after 60 days, you really have to say, okay, is there something that indicates that this is just a short-term thing? Okay, maybe then we can wait until 90 and then we put them default. But if not, you probably should put them already now. You should at least do some investigation. So if we move to the next slide. So if we are really, really strict, I mean, the only strict reason in IFRS 9 while you need to do a PD calculation is actually the significant increase in default risk, or the significant default in credit risk. Because this sort of SICR concept, quite interestingly, because you hear, okay, there's a significant increase in credit risk. You might assume, oh, okay, it could be that the PD went up or the LGD went up. So the LGD, that is that there, for example, collateral recovery became worse. But actually, the standard really clearly say to you that the significant increase in credit risk, the assessment based on we should look at 12-month losses or lifetime losses. That depends on the PD only. That depends only on the change in risk of default. So this means that it is mandatory for you to do an assessment. Now, you could argue that you could do all sort of way to sort of do the PD assessment in a different way, but it's a very nice way to use the PD because it lets you sort of satisfy this criteria in a very nice way. And it means that also that you sometimes see this sort of simplified IFRS 9. So that is, when you have, for example, things like receivables and so on, and sometimes, because that goes under the simplified IFRS 9 standard where you don't need to do a stage 1, stage 2 split. Therefore, sometimes you hear people say, okay, but in this case, we don't really need a PD. We will just do this over a loss rate. I would still argue that the PD really makes sense to do because in the case of the PD, you understand, okay, is the customer going to get into trouble? Well, the LGD is much more about you going now into trying to collect on collateral or similar. It's quite different sort of processes and quite different variables that is influencing it. So if we move to the next slide. So basically the conclusion here, the sort of bit of the intro here is, why do we need the probability of default? Fundamentally, you can't really reflect the ECL correctly in the stage 1 because in stage 1 you base the ECL on the probability for default within the coming 12 months. So this is very important. As you see, basically what it says here is that the ECL you have when you're in stage 1 should be a subset of what you have in stage 2, where you say, okay, I include the default events that takes place over the coming 12 months. So this is why, it becomes quite hard to do the calculation if you don't really have a PD to start from. And you might now say, okay, where did this 12-month really come from? And it turns out the only reason we really have that is because IRB, so the capital calculation standard, they use 12 months for their calculation. And basically, when ISAB sort of created the standard, they just basically picked that. But then typically, and this is what we will a little bit went on to here, typically it's not enough for you to only say, okay, I calculate, a 12-month PD, and then you realize that, okay, you're actually going to need more, because when you go into lifetime, you are going to need to look at the lifetime PD. But even within the 12 months, you might actually have to understand, where did the loss take place? Or where did the default take place? Did it take place during the first month, or did it take place in the end of the 12-month period? So with that sort of intro, let's actually now move into looking a little bit at the sort of methodology on how we really do PD measurement. So if we go to the first slide, or to the next slide. So here I've a little bit tried to illustrate sort of two different alternatives. There are many ways how to do PD calculation, and many ways how to do the sort of term structure where you sort of extrapolate. So I would say one of the methods I will not be talking about, but which is quite common, is that you first build something like a logistic regression model for the PD12, so for the 12 month or 1 year PD. And once you have built that, you then build up some sort of term structure thing that allows you to now estimate, the lifetime PD, and also where will the default take place. I much more argue that you typically should try to do both things at the same time. It becomes quite awkward that, first you build one model and then it needs to be fed into another model. And I argue here that there are sort of two different routes that you can go along, and we would look a little bit at these two routes. So one is the sort of Markov chain route. Basically, that means that you often start from that you have an internal rating system internally in your organization, and you now say, okay, I would like to make use of that. The second approach, which is the sort of survival methodology method, is more that you say, okay, I have some data, and I basically would like to see, when in time is the account defaulting. So we will look at both of these two methods and look a little bit at the pros and cons between them. And of course, you could dive into all sort of technical details, but at this level, we will give sort of a little bit of sort of pros and cons to them. So if we move to the next slide. So if we start with the sort of Markov chain route, basically what does it mean to do this sort of Markov chain calculation? Well, it means that, I write down basically a matrix where I say, okay, what is the probability that, if let's say that we have, AAA, AA, single A, and then B, and then default, for example. So, you have these sort of 5 states. Okay, so if I am in a AA, what is my probability to, for example, next month or next quarter or next year, depending on the time scale I use? Typically, sort of monthly time scale is often sort of easier to calculate with. So for the next month, what is my probability that I will now have changed the ratings, and what is the probability that I will have gone from a AA to a single A, AA directly to default, AA to AAA, and so on. So this is the sort of Markov chain method. And the nice part in doing this, as we say here, is that it provides a closed formula for the default probability from any state. It's also quite nice that, you will have these direct matrix elements from which you can basically sort of move around between that. And you will also be possible to sort of simulate, things like, changes in balances and so on. You're basically simulating the full route. You're basically saying, on its route to default, how is the account going to move? So this is the sort of the Markov the chain. Now, the problem of the Markov chain is that it's very reliant on the fundamental thing called the Markov property. So the Markov property is this idea that what the rating I'm currently in. So if I have a loan that is in AA, what's going to happen with this loan the next month only depends on what's going to happen only on the current state. So it does not depend on the past history. There's no history dependence. And that is often quite a strong assumption. Sometimes it can be this isn't a huge problem, and it can be a quite efficient tool. But sometimes it can be quite a challenge. And as I say, the big thing that you tend to get in trouble with, it was called momentum effects. So sometimes you see, for example, people doing these sort of calculations for delinquency buckets. So you say, okay, if it's sort of up in time, and now I write down sort of matrix between these. The problem is that what tends to happen is that you move very quickly between the buckets. So what you tend to see is basically accounts doing one of two things. Either they make sort of a quick recovery, or they make a very sort of steep decline and they just keep declining on. And that means that if you have something that now sits in, for example, it's 60 days delinquent, if it was sort of 60 days delinquent last month as well, or if it were in 30 days delinquent and were 30 days delinquent last month as well, they often behave very differently from someone that changed rate quite a lot. So the Markov method tend to work quite good or reasonable when changing in ratings is a rather rare event. You often stay in the constant rating for very long, and then from time to time there's a little bit of risk that you do a rating change. Then this tends to be quite a good method to work with, but it works much less if you have these sort of very frequent rating changes. And as I say, also finally there's a little bit of a sort of fundamental ambiguity here, because fundamentally you define all of these IRB ratings to be that you shouldn't really change, for example, on the macro conditions and so on, and yet this is the dynamic we want to go with. So if we move to the sort of next slide to look at the sort of Cox alternative.
So, Jacob, before we go there,
Yeah.
uh, we have Anamika Mukherjee who just mentioned she wanted a little bit of slight more elaboration about the LGD part.
And we will
We'll come to
hopefully
that.
get to mention a little bit toward the LGD toward that. Unfortunately, on this talk we will be primarily more talking about the PD, but I'm happy to bring in a little bit on the LGD toward the end as well, because I agree that is a very fascinating topic.
Sure, I'll move on to the next slide then.
Yes. So if you look more at the alternative, sort of the Cox regression method. Well, let's actually do this. Let's actually move. Let's move forward one more slide, and we will come back to the Cox one to talk about, because we will actually now illustrate a little bit how to work with this sort of Markov method. We will look at both the Markov method and the Cox method in the specific concept of the low default portfolio. So in this case, you have a very sort of good quality portfolio. You have seen very few sort of defaults, and the question is, how are you going to calculate this? So if you move to the next slide, we will look at a little bit how to do the Cox regression. No, how to do the Markov chain, I mean, of course. So the Markov solution of this problem is basically that we say, remember that we said, okay, I look at my ratings and I look at the rating migrations. The idea is that what I really could do is that I use a quite short time scale, and I can even do that. I let the time scale become very, very, very short. And what I do when I do that is that I basically start looking at the route to default. So let's say that you have a AAA loan. You might say, okay, I've seen very few AAA go to default. And we say, sure, it's going to be hard for you to directly estimate that. But what you might have seen is, from time to time, you might have seen AAAs go to AA. So you at least know, okay, roughly what is the transition probability from a AAA to a AA. You might have seen some AAs at least go to single A. So okay, I know what's going to happen if I go from AA to single A. And I think you see a little bit where I'm going now. So you can't say directly, because you have very, very few observations of the AAA that directly went to default. In this sense, it's a low default portfolio. But you have seen AAA go to AA. You have seen AA go to single A. You have seen A go to, let's say, triple B and so on. And you basically have seen some of the transitions everywhere. And what you can now do is you can paste these together. And this is a little bit what I try to illustrate here in the picture. So you sometimes call, something that is investment grade and which fall down, you sometimes call that a fallen angel. And this is a little bit what the philosophy is here. What you will do is you will monitor and use the data on triple A's and double A's and so on, and of them losing rating 1 notch or 2 notches. And you will then combine that with once the loan have reached bad sort of quality, what is now the probability for default there? And you can combine these two together. This is sort of the core philosophy. So if we move to the next slide, we will see a little bit how to do that mathematically.
So while I move forward to the next slide, Jacob, I would just like to mention that Asim Alam has already put in a question whether we're talking about two methodologies over here. Are these
Yes.
the only two methodologies that is there?
No. So I mean, there are quite a few, and I mean, I would say that these are two very common one, and the third one, as I mentioned, is often this idea that you first just build a PD12 model, and then you will have to tack on some sort of curve to get the rest. I would say these three are the most common ones. And right now on the top of my head, I actually cannot remember. I mean, you could do all sort of things. I mean, you could argue even that you could do some sort of machine learning where you try to get the PD sort of right away without sort of breaking it down this way. But I would argue sort of structurally, especially these two methods I bring out here is quite nice because they illustrate sort of that you try to align a little bit a lot of the business information. I mean, after all, if you have a setup internally where you have these ratings, you would want to have these ratings internally and think about them. So what one can do here, what I illustrate is, as we said, we have this Markov property, and we assume that to be true. If you take that, you can basically say, okay, before I said, should you use years or should you use quarters or should you use month? Well, you can actually do that. You do almost like a limit process. So you take very, very, very short steps in time, and you let that sort of time step goes to sort of zero, or you take the sort of number of steps to infinity. And if you do that, you actually get the limit you get is what's called an exponential matrix. So this matrix G that you see here, this measures sort of the intensity of the transition. So it will measure, it will mean what is the probability to change rating per unit time. So the matrix that I've shown here, in this case, I've shown a very, very simple, the absolute simplest model you can do, which is that there's always the same probability per unit time, lambda, to be downrated. And there's always the same probability per unit time, mu, to be uprated. So what you see here is that you will have a triagonal matrix, because in this case, you will be in a certain state. Per unit time, there's a probability lambda to go to a worse rating, and there's a probability mu per unit time to go to a better rating. And this is then the G matrix. And you now take this G matrix and you take and you exponentiate this. And what's very nice is that most sort of computational software, like Python, R, similar, they have this sort of exponential matrix already built in. I mean, you could, in theory, calculate it yourself as well by finding the eigenvectors and so on of the matrix. But it's often quite nice that this is a tool that you can then use. One good example, for example, that I often use to illustrate why I really like this intensity matrix way of doing things is that, let's say that someone now want to do stress testing. I want to say, for example, are going to be common.
Excuse me.
This is a very complex exercise.
Hello, Jakob.
Yes, you're audible. Please go ahead.
I just wanted to ask that your voice is breaking at the moment, and from stress testing onwards, I was not able to hear.
Okay, let me take it from stress testing again. Thank you for pointing this out. Hope that we will have a more stable connection. So when you talk about sort of, I mean, as I say, a good example where I think this makes a lot of sense is when we talk about it from a stress testing perspective. Because let's say that you have set up this matrix structure. Someone now comes and say, okay, we would like to say in a stress, we think that down ratings are going to be more common. As an example, we think that down ratings are going to happen twice as often as they happened before. That means that you multiply all of these lambdas by 2. And now you just exponentiate the matrix and you will have the answer. If you instead worked with a state matrix, the original S matrix, that where you just look at the sort of observed probabilities, it becomes much harder to do this exercise because you cannot just, for example, double the probability of a down rating per year. Because if you double that, they're not going to sum up to 1 anymore. So you have to somewhat lower the other things and so on, and it becomes a whole set of mess. But here you can just say, okay, this specific matrix element, I think that's going to happen more often. I multiply that by a factor, and you still have a well-defined transition matrix once you take the exponentiation. As you see, the trick is that you will have to set so that the diagonal always has the negative one, because this is what makes sure that you always get this normality property of the matrix. So this, I would argue, let's say that you have very little data, but you have these nice ratings. You have data on, when do things migrate between them. This can be a good way for you to actually be able to estimate the default rate, even for very, very good. Second thing we could now
Jakob,
move
we
to.
lost you again.
Yeah, sure.
We lost you again for some time.
Apologies.
Jacob, we lost you in the last 30 seconds.
Okay. Do you hear me now again?
Yes, loud and clear.
Yes. So you hear me again. No. So what I was saying was that the advantage of this sort of setup with an intensity matrix is that what you now get access to is the fact that you can directly multiply the direct matrix elements. And if you take that matrix and you take the exponent of it using this exponential matrix, you will always get a matrix that is satisfied the normality, so that the sum of the probabilities always sums to 1. And this is quite convenient to have a sort of automatic way to do this. So in this sense, it often becomes a quite efficient way of doing calculations. Hope I am. Do you guys still hear me?
Yes, you're clearly audible.
Yeah, excellent. All right.
Do you want to move on to the next slide?
Sorry. Yes. Let's move to the next slide.
Mr. Jacob, I just have a question here.
Yeah.
You are completely audible. I mean, I can hear the entire session. So my question is regarding these time steps, right, which you have described just now. Like you need to take it to infinity, have a lot of time steps as possible. But when we are developing these ECL models, for example, we have an amortization schedule. Maybe the payments are coming in, the prepayments of these customers are coming in on a monthly basis. So why should we go into infinity? Shouldn't we fit?
This is an excellent point that you make, and let me actually make a.
Which is coming in.
Yeah, I understand what
So it's
where
more discrete rather than continuous. So how do I correlate that using this?
Yes, thank you so much for bringing this question. I think I should make an additional clarification, because you are right. So what I mean by you make these time steps, that's more of a mathematical construct. At the end of the day, the way you will use it is that you see sort of that S equal to exp y. That will then be the original time scale. So if you say, okay, that for example, I work on a monthly level, this will take you back to the monthly level. And the way that you do it is that you will treat these sort of the lambdas and the mu, for example, in these cases as parameters. Then for example, you fix some values of these, you put them in the exponentiation, you calculate the S, and what you will now do is you can then do maximum likelihood to say, okay, I would want an S that fits my observed the observed proportions. So the idea, I think this is a very, very important point, and I'm very glad it was brought up. So the idea is not that we operate everything on sort of an infinitesimal timescale. That's more of a mathematical construct for us to be able to derive this link between the S matrix and the G matrix. But then when we do the actual calculations, we typically operate on a monthly level. So thank you so much for clarifying that, because my point is more, typically we always recommend to operate on a monthly level, because this is typically what aligns with amortization schedule and so on. But this is more of a sort of mathematical way to derive this link between the G matrix and S matrix, because the G matrix is much easier to operate with. It requires fewer parameters, and it gives sort of a better way to describe the dynamics. And it's in particular very important when you have a very sort of low default sample, where you be able to.
Hello, Jakob?
All right,
Matrix.
Jakob, you just dropped off for the last 30 seconds. Could you repeat the last 30 seconds?
Okay, so apologies for the connection. So what my point is that, which I thought was very good, that was articulated here, is that when I say you take these very short time steps, that's a mathematical construct to get the relationship between the G matrix and S matrix. But when you do all practical calculation, you do them on a monthly level. So you don't do this sort of, that you talk about, every day or every second or something like that. This was more of a sort of mathematical trick. The point is that you set your G parameters, these sort of lambdas and mu's, you calculate the S, you use the observed data, which is often on a monthly time scale. You use that to be able to fit with, for example, maximum likelihood and similar, to fit the lambda and the mu parameter. And now then you keep calculating on a monthly level. The point is more that you will often get a better matrix by starting from the G and deriving an S, compared to working with the S matrix directly.
So you mean to say that first we compute the S, okay, we have this G matrix available, and then in order to equate both of them, we would be using some sort of, let's say, an estimation technique, correct?
Yes, exactly. Exactly. So you typically, what you typically do in practice is you create an observed S. And then what you will do is you will set a G, set it with some parameterization. In this case, for example, I used a very simple one which only have 2 parameters, but sometimes it can make sense to have more. After all, it depends on how much data you have. And now you basically use maximum likelihood to get them as close as possible. So you can almost see this a little bit as a smoothing method. Typically, you have tons of data, and you, for example, apply on a linear regression. That is, in some sense, a simplification, but in some sense also, you don't believe that all the noise is going to be relevant. And this is a little bit of the same technique, and it's especially very powerful when, as I said, maybe you have never seen a AAA loan go to default. Should you set the default rate for a triple loan to 0? No, it's probably just that it's so unlikely that you haven't really observed it. But the point is, if you do this method, you will actually always be able to get a non-zero, as long as you have seen a AAA go to AA, you have seen a AA go to A, and so on. As long as you've seen one chain that ends on a default somewhere, you will actually be able to say that the default rate is non-zero. So you will not get this problem where you say, okay, the default rate becomes unrealistically low. So this is a bit, you should always see this as a bit of a smoothing scheme.
Okay.
Thank you.
Okay.
So,
And another thing is that if we can estimate, let's say, annual transition matrix, or let's say the hazard matrix, which is called this, okay, and then basically we can convert this annual hazard into monthly to align it with the amortization schedule, correct? We can do that, right?
Yes, that is a really good point. So let's say hypothetically, I think this is again a great point. Let's say hypothetically that, for historical reasons, people have only stored the data yearly or annually or something like that. Then this is a great, because again, exactly, this is what you then do. You basically use that observed S, get the G, and then you basically use the G to actually calculate the matrix that is on a monthly time scale, because that's just in the X factor, you would just put G divided by 12. So this is the nice part, that if you want to say, okay, I would want to take, on a monthly level, then I take the annual G and I divide by 12, take the E to that, and I automatically will get an annual matrix. Or I will get a monthly matrix. So this is also something that's very nice with this tool, that, if you want to sort of basically change the sort of sampling of it, it's on the G, it's just a scalar factor. It's just a constant that you multiply with it to change the scaling of it.
Okay.
But that's also a very good point.
All right. So, perfect. Thank you so much. I think the questions have been coming in quite uh, in sync with our expectations. So I understand that this is an area of curiosity, and Markov-based solution is rich in its complexity. Having said that, I know we have time. I would request Jacob to move forward. We would also
Yeah,
like to get
let's
more
let's continue
as
on.
well.
For the Cox regression, that is the next slide. I have considerably less to say also. So in the Cox regression, what you typically do is that you don't have this sort of structure at all. So Cox regression, for example, is quite common when you don't have these rating structures, but you rather have, you just have the observations themselves. So what you typically tend to do there is that what you can do as a model is that you first say, okay, I know sort of the default rate per unit time over time. So you sort of derive a vintage profile per unit time. So now you instead have it as a function of time forward. And you then assume, either you assume some rating dependence or you assume some other variable. And you basically assume that what that does is that shifts the overall vintage profile. So you basically take, what is the risk per unit time curve? So that could be some variable curve that you have first fitted. And then you take this sort of scalar factor and take e to the power of that scalar factor, and that then give you a shift. And that advantage now is that you can then say, for example, in the case of ratings, that, okay, the AAA should probably have a smaller shift than the AA, we should have a smaller shift than the A. So in this case, the way that you can sort of enforce and that you can sort of look at the correlation between your different ratings is rather that you look at in how the offsets take place. So that's rather the way that you do, and you can use, for example, Bayesian methodology to dig into that. So
a question.
Yeah.
So basically, from your first point, the H of vintage that you are calculating, so it will be, let's say, a time series of default rates. It would be something like that.
Yeah. So what it will basically be is that it will represent the risk per unit time each month for a default. So what you basically have is, what is the probability of default, the per unit time for the sort of first month, given that you have for the first month. For the second month, it will be what is the probability of defaults of this month, given that you survived the previous month. So this sort of hazard basically describes sort of this, given that you have survived up until now, what is the probability to default this month?
Exactly. So is there, let's say, I'm actually curious on using these methods, hazard rate, and I've not been able to find any example that would allow me to calculate this. Is there any Excel spreadsheet or something like that which could help me to understand this approach?
I mean, I can. What I can do also is, because I've actually developed. I have one which we use for sort of internal training. I'm very happy to send that out. So what I will do is, I will send that one to Dexlab, and they can also email that one out then after the session. Because I think that could be super interesting for people to get to see. Where I've used I've used this sort of survival method, and there I've also used both to sort of also combine it with the amortization schedule for a loan. So I think that could be a nice example for people to see. So let me email that one out. And
Thank you for that.
and then if someone has some questions on it, happy to look at that.
Thank you for that, Jakob. We'll certainly forward it to all the participants, including Asad. We need to be a little mindful about the time. I think it's a Sunday for majority of the people in the audience, and there would be certain evening commitments everybody would have. So I would request everyone to park the questions in the chat box. We'll take up the questions in the chat box as a follow-up Q&A. In the meanwhile, I would request Jakob to kindly continue forward with the session as it is.
But okay, let's continue now. So if you take the next slide, we have just looked, very, very briefly at these two methods. One method is this sort of Markov chain. One method is this sort of survival Cox methodology. And let's now move to the final topic that we will be discussing today, which is the SICR assessment. And I think we will be focusing now primarily on the conceptual side of it. So, the question here is, why do you really do a SICR assessment? Well, the fundamental reason you do a SICR assessment is that if you go back to the 2009 proposal, this is what their original plan was. So the original plan was that you would do similar to how I started talking about at the beginning of the session. You would do a fair value metric. You would basically say, okay, I have my contractual cash flows, I have my credit losses, I discount these, and I should get back the fair value. And I then basically estimated that. This was sort of the original plan, but if we move to the next slide, the banking industry did not like this idea, because the problem was that in order to calculate this, the discount rate would have to be solved for, and the discount rate would be a combination of contractual cash flows and credit risk, and that was deemed too complex to do. So if we move to the next slide. So instead, the solution that was developed, for example, in US, was that you do a two-step calculation when you do your IFRS 9. So what you do is that first you only look at the contractual cash flows, you discount them using an effective interest rate, and they should be equal to the original transaction amount when you start out the loan. And so in order to get this equation to work, you have to solve for the effective interest rate. So it basically becomes sort of the internal return if I don't include any credit losses. And then in step 2, I take the expected credit losses and I discount them using this effective interest rate that I just calculated above. And that becomes the ECL. So this was sort of the original proposal. But then if we move to the next slide, the problem of using this method, so using if the method I just showed would be full lifetime ECL. The problem in using full lifetime ECL would be you get a massive day one effect. So what happens is that, day one, you would book in all credit losses for all the future. And ISAB, the International Standards Committee, they pointed out that the problem then would be that it becomes quite weird. So, for example, a good example is when I worked for one bank, we did a big portfolio purchase. So, you negotiate the rate and you negotiate the value of the loans. So this is what you start with. This is the transaction amount that you pay for it. And still, even though you have sort of paid less because the loan quality was worse, you still take a credit loss. And it's very, very hard to explain this to management. So ISAB said, we don't want this day one effect to be too big. We need to sort of find a compromise on this one. And in order to do that, if we go to the next slide. So in order to do that, what they did was they introduced this stage 1, stage 2. So in stage 1, you basically say, okay, since I have not really taken more credit risk than I thought when I originated loan, I am protected by the fact that the original interest I charge will have a premium for the risk I thought I took. Ergo, I don't need to take the full credit risk at day one, and I only take it 12 months ahead because 12 months was a known sort of quantity. People had models for that. And then if it turns out that the risk is much higher than I thought, okay, then I really need to take this stage 2. So I think this is one of the, if there's one thing I want you guys to remember from this talk, this is the reason we have this stage 1, stage 2. And this is really why when you do stage 1, stage 2, you have to make this relative assessment that you will have to look at, have it increased relative, because it's not the absolute level of risk that matters, because the absolute level of risk you can protect yourself against, because if you give out a risky loan, you also charge a high interest. But if you thought the loan was safe and you give out a high risk a loan that turns out to be very risky, now you are exposed to the credit risk. And this is sort of the reason why we do the staging. I mean, I think sort of because I mean there's a little more sort of details that's coming in the slide where I go into some sort of little bit of technical side on how you can do this. What I think is, because we are a little bit running almost short on time, so I rather think that it's better that we sort of take some of the questions that are in the chat and on the final few minutes, and we will, I mean, the slides will be sent out, and should you want to, because what I will do in the rest of the slides is just basically take that principle and then put some numbers on it, and then show a little bit how one can test that out. And happy, if someone have some thoughts about that or want to look at that to discuss that. So what I'm thinking is to look a little bit at the question. So there was one really nice question that came in: how to decide between this Markov method and Cox method, and a rule of thumb. So I would say the key rule of thumb is, first and most, for the Markov method to work, you need to have ratings. So the Cox method works no matter if you have a rating system or not. You can still use Cox method even if you have ratings. But if you have no rating system, you're going to have a really hard time. The second criteria I would look at is, I would look at how common are rating transitions. If you have, if rating transitions are very, very, very common, Markov methods typically doesn't work as well. Well, if they're quite rare, and for example, corporate lending is often quite nice for the Markov methods, because corporate loans always stay for a long time in a specific rating, and then they change. So this is, I would say, a little bit of the rule of thumb I would use.
I think Jacob, did you get dropped off?
Oh, sorry. So the question was, when to go for Markov method or Cox method. And I more said that, Markov method require you to have ratings, and it require rating migrations to be quite infrequent. If you have very frequent rating migrations, Markov methods typically doesn't work as well.
All right. So Pranay has a question: how are lambda and mu estimated?
Yeah, great question. So you typically estimate them using a maximum likelihood method. So what you do is, as we a little bit talked in the conversation, is that you will calculate an observed S matrix. You basically look at which migrations did I, for example, have on a monthly level. You get so you see, for example, okay, I had 5% chance of this migration and so on. You get that observed probabilities. And then you calculate the matrix. You make the exponential matrix. So you, for example, set the parameters to some value. You take the exponential matrix and you see how do you do to make the S matrix you get from the G. How do you make that as close as possible to the observed one? And you can make that notion, of course, precise by you deriving the maximum likelihood estimator. So what you do is you do the maximum likelihood estimator that minimize the gap between the observed S matrix and the actual S matrix. That's sort of the best one.
All right. Thank you so much for that. So Akshay Pawar has a question wherein he wants to know, while working with low default portfolio or even for no default portfolio, what if the count of population in one of the delinquency buckets is 0? Pluto Tashke helps in calibration of default, but what if the count is 0 in the delinquency bucket? How do we address this?
Yeah. So this is where I think the Markov method really stand out as very neat, because as I said, even if you have a AAA loan and you have never ever seen a default, that's not necessarily a problem in the Markov method, because you could still have seen AAA go to AA. And in AA, you have seen AA goes to, for example, default. Or maybe you haven't seen AA go to default, but you've seen AA go to single A, and you have seen single A go to default. And this is a nice thing, that what the Markov method will do is that it will not focus on will you go all the way to default. It will say, okay, to go to default, AAA needs to become AA, AA needs to become single A, and so on. So it can map together these probabilities with each other and give you an estimate. When it comes to the sort of when it comes to the method for
Jacob, so what you're trying to suggest is that in this case, when you have fewer defaults, basically, or rather no defaults, you're essentially saying that the downward migration or the transition will be used as a proxy for a default. right? That is what you're trying to suggest.
I mean, yeah, I mean, or I would rather say that, you know, if you take it the sort of simplest way, I mean, one way to view it is that, so you say that, let's say that we make an even simpler case. We say that there's an A rating, a B rating, and a default rating. My point is that for an A loan to go to default, in this model, you first assume at some point in time it becomes B, and then it goes from B to become default. So the point is, if you rather well know what the B to default is, you know per unit time that what that is, and you know what the probability to go from A to B is, then you basically look at the product between them. So you combine these two, and this is what this exponential process does. It basically it looks at, sort of the after one short while A went to B, and then after a short while it went to the default, and it combines all these probabilities together. And this is sort of so it's not really it's not really a proxy, but it is really an exact way of calculating it from using sort of all the indirect paths. So you don't focus on the direct route, but the indirect route.
Sorry to be interrupting you. Just
Yeah,
one
no problem.
clarification. Say, because we are talking about a hypothetical case or maybe a real case where there has been no defaults. So you essentially have a past data from movement from A to B, but you probably won't be having any data of movement from B to D. So you kind of stop from A to B, and that kind of captures your default because you would
Yeah,
not have any
so
data, right?
I get the problem. So I mean, a problem could of course be if you have never ever seen any default anywhere in the data set.
Right.
Then of course that's going to be an issue. But so what I would rather, in that case, also say is that it depends a little bit on the sort of quality that you have. So if you have a normal sort of corporate loan portfolio, you will typically have some slightly worse borrowers that get a lower rating, and it's from them you can estimate low rating to default. But I fully agree with you that if you have, for example, the case of sovereign lending, for example, there you typically will have very few, or for example, one of my former colleagues works for municipal lending in Sweden. So he lends to municipalities. We have never ever seen a municipality go to default. So one method, what you can do, and it's not a perfect one, but it is basically that you have to use a Bayesian method, and you have to basically put on a prior. So you say before you've seen the data, you say, okay, I basically have that, I put on these intensities. I put on, for example, a distribution like a gamma distribution. So they are not zero. I put on a distribution on them. And what the data will do is, because I have never seen a default risk will become quite low, but it will not become zero. Of course, the key question is then how to set these sort of priors in a good way. So that means that you will have to make an expert assessment and say, okay, even before I saw the data, I think a sovereign default might happen, once every 10 years or something like that. And then the data update that estimate. If your guess was close to what also the data indicates, it will not really change that much. But if you guess too high, what the data will do is that it will move the estimate down, but it cannot move it down to zero because you've only seen finite amount of data. So I agree with you that this is a really complex case in practice, but my argument is often that, for example, in corporate lending, you should then say, okay, if I'm not seeing any defaults in my portfolios, maybe I need to widen the portfolio slightly and take in some other exposures of lower quality where I've seen these transitions, so I can combine them together.
Okay, thank you.
Thank you for that insight, Jakob. So we have another question wherein one of the attendees have asked that in some wholesale IFRS 9 PD models, IRB PDs are used as an input in addition to the MEVs. How do we ensure IRB PDs are unbiased as they are conservative to start with?
Yeah, but I mean, the most important, this is a really good question. So the most important thing, of course, is to make sure that you use IRB PDs before you applied any MOCs, so any margin of conservatism. So this is also why it's really important to have a really good data flow. So if you're only given the final IRB PD parameter, you're going to have a problem. But if you have an IRB work stream that's pretty open, you should be able to move back in it and say, okay, can I get the raw IRB PDs before you guys put on any margin of conservatism on it. So I think that's first and most important, to move back and sufficiently remove all of these sort of margin of conservatives on it. And as I say, then it can be a sort of quite nice starting point. I also would argue that I think that the IRB PDs are often not the thing that you want. What you want are the ratings. So it's all, this is a little bit, if again there's one takeaway point I want to give, is that if you work together with IRB people, what they are great at in building rating systems, and this is what we as IFRS 9 people really can make use of, because there we don't need to worry about conservatism. We only need to worry about, if I am at a certain rating, I can condition on that and then use that. But the PDs themselves, I might have to calibrate on my own. So, because if you think about it, IRB PD calculation is not really a very sophisticated method. It's basically that, you have a rating and they just look at everything that sits within that rating. They basically use that for the calibration. That I think we can do much better in IFRS 9 for our purpose. But the rating system itself is very nice to get from IRB.
All right. So are you talking, I believe you're talking about external defaults, right? We get these external defaults from rated portfolios from organizations such as Moody's and S&P, and they can generally be used as a proxy for a particular industry.
Oh, okay, yeah. Then I guess then I mean what is important there is that so you can and you can still, of course, let's say that that's the only thing that you have. Okay, I mean we always work with what we have. That is the end goal. It's not an option to say, okay, I cannot do anything. I work with what I have. Let's say that that's the only thing that you have been given. You have no opportunity to go back within the flow. You cannot be given anything else. Then what you still can do is that you can treat them as a covariate. So what you could, for example, do is you could take these PDs and you could, what you could do is you could for example, transform them into hazards and then say, okay, I basically take a certain proportion of that. So you try to basically, you still use them as a variable and you use them as a variable in a regression, but you don't use it directly as a one-to-one relationship, for example.
Sure. I think we are on the same page with that. We have one last question to go, last 4 minutes. Before that, I would remind everyone in the audience that we put in a quick survey form in the chat box. It will barely take 30 seconds for all of you to fill it up. It will help us organize better sessions moving forward. As a matter of fact, we do realize that we need to do yet another conversation with Jakob on this topic itself. So Jakob, the last question for the session today that is coming from someone is that which is the best method to model unrated borrowers?
I mean, my most experience actually come from retail lending. So that is, your classical unrated case typically. I actually started out working in unsecured lending. And I would argue there is really where let's say that you have a lot of unrated borrowers. There, these sort of Cox regression methods really shine. Let's say that you have so that's there I would say, Cox regression for unrated borrowers, if you have a lot of them, like, retail mortgages, retail unsecured, something like that. Let's say you have more like retail, corporates where you don't have as many. Things start, of course, to become quickly more complex. I mean, as I say, as soon as they are rated, you have something to go with there. If they are not, I mean, you might then consider, are you an institution large enough that you want to go the IRB route? Then you anyway are going to have to build an internal rating system. If not, you might need to go a different route. So then I would more recommend that you go down the route of looking at, for example, the way this sort of, what you can basically do then is that if you have, for example, our bank, we work quite a lot with sort of, mid-sized commercial real estate. What you can do there is more that you look at the balance sheet of them. So you look at, for example, okay, what are their income? What is the debt they have? And you now do a simulation and say, okay, under what circumstance do they go default? And you look at sort of how easy they can go default. Okay, how much can I change the income? And you can now use that as a starting point for the PD estimate. That's much more of a clunky way of doing it, and it's not as sort of nice statistically. But the whole point is that you typically only go with these methods if you don't have the statistical data. If you have, you have a number of borrowers, that when they've defaulted, that's typically a nicer method.
Mr. Jacob, Yeah, the question that I was actually asking was on the advances portfolio, where like Indian banks, we have LCBD exposure, letter of credit bill discounting. Basically, my bank has an exposure on the client, but actually the what do you say? The onus is on the counterparty bank to actually make the payments. So in this specific kind of a facility, because external ratings of banks, we can decipher it from their possibly tier 1, tier 2 specifically kind of bonds, but external PD transition matrix are not actually available. And secondly, the unrated that I was talking about is on the investment portfolio, where we have investment in government securities portfolio. So can you address these 2 points
I mean,
specifically?
so for investment yeah, for example, government and these sort of large, I would typically say very few institutions will internally have sufficient data on this or sufficient capability of this. My recommendation is typically to go with you look at sort of Moody's and S&P, and you start from there. To be honest, from an IFRS 9 point of view, unless you're a very specific sort of provider, this is not going to be material. Again, I gave this example that, a colleague of mine worked for. It's called Kommuninvest here in Sweden. It's basically a bank that lends to municipalities. We have never seen a municipality fail in Sweden. And it's not that credit risk is a material part of their business model. I mean, there are other things that matter quite a lot. So I would argue there it's also fine if, you more take what, S&P and Moody's give you, because it's not going to make a huge amount of difference. Where it really matters and where the ECL calculation do make a lot of difference is in these cases where you have where it really sort of the credit risk can be quite material. The other case you mentioned is when you can have, for example, two final points I want to make on the question. I think super nice question that you have. So if you can have two things, if you talk about counterparty level, it's important to say IFRS 9 is always made on facility level. But that said, you can still notice that even if it is on facility level, you can still use counterparty variables. A further case, if you have this sort of nested structure. So let's say that you have a subsidiary company and they take out a loan. They take a loan, but there is a guarantee from the mother company. In that case, it's important to say the guarantee will not influence the PD, but it will influence the LGD. This is really important distinction to make. So it's always the legal entity that have borrowed from you. It's on them you look at the PD, and what the mother company does, that goes into the LGD. So from a SICR perspective, if you have a little shaky subsidiary who took out a loan, but you have this guarantee from the mother company, that means that it's still on the PD of this subsidiary that you have to look at the SICR assessment, and you have to do the PD calculation, and you instead have to take the guarantee from the mother company on the LGD side. I have been in these cases where we have had really, really shaky companies in a previous bank I worked for, but they were all guaranteed by a really large company, and then that goes in the LGD. So you can still have these stuff going into stage 2 then.
Perfect. Thank you so much, Jakob, for such a clear, insightful, and deeply practical session.
Thank you
From
guys so much
modeling.
again for all the very nice questions. It was a really, really interesting discussion.
Thank you so much. I'm sure there's a lot more that the audience would like to know about, and we're already getting some motivation in the chat box. People are commending the work that you've done. Uh, you've covered it all that we wanted, right from PD modeling foundations to SICR frameworks, low default strategies. You even touched upon the complexity of Markov models. So I'm pretty sure I speak it on behalf of the entire audience that today's discussion was rich, relevant, very real world. Uh, like I said, there's so much more that you have, left for us. Here, I see people putting in messages that it's great to hear from Yakov. It was quite wonderful indeed. For the audience who is over here, thank you so much for taking out the time on a Sunday and spending this time with us. We understand that Sunday is one of those days you would rather spend with your family, if not even friends. I know it for a fact that majority of you are mid-senior and senior level professionals, and you will shortly receive an email from us, probably by the in the next 3 to 4 hours, which will contain the following. It would have the access to the recording of the session. We've recorded the whole session for your benefit. We will also provide you with the presentation that we shared on the screen. In addition to that, Assad had requested for a certain data, which will go in as well. We'll just collect that from Yakov. We've also sent an email to you already right now, which contains the quick feedback form. Should you have any queries, please feel free to mention over there in the feedback form. It would really help us create better sessions moving forward. And should you want to go deeper into IFRS 9, we do have an advanced training program about the same, which has real-time case-based learnings, industry certification for the industry professionals by the industry professionals. I see raving feedback coming into the comment section. People are saying, okay, and thank you, Akshay, for acknowledging. I think I completely missed introducing myself. I am Vivek. Thank you, Akshay, for that. And Jacob, some really, really interesting conversations happened today. So, with that, I'm putting an end to this session. Please write to us on email. Please write to us with any queries that you have. Should you want to do anything further, you do have our contact details. Please do reach out to us. Thank you, everyone. Have a good day. Uh, we look forward to staying connected and look forward to conducting many more such sessions. I would request the core team to stay back, and I would request everyone else to drop off the call.